I'm going to present a paper on, which is an experimental paper, which is something I started working recently. And so this is also, somehow a new thing for me. And this particular paper I thought was perhaps more interesting for this audience, because what I really try and do is to use some models from physics and complexity and trying to see how they could perhaps explain how agents learn the value of an asset in a financial market. So this is what the paper is about. So it's learning and information diffusion, and the type of market we are looking at are decentralized markets, so over-the-counter type of markets, and we try and combine some experiments and a computation model that can reproduce, if not necessarily fully explain, the experiment results. And this is work in collaboration with Nobi Anaki and Pietro Vassallo. Nobi is a more traditional experimental behavioral economist. So a lot of the experiments were initially done in Nice, then Nobi moved to Japan. So actually the data that we retained are those from experiments in Osaka. Okay, so what are the questions we ask? So the question really, the central question really is about how do agents learn the value of an asset in a financial market? And the way we want to try and understand it is by using the network structure of the market. So the idea is that we know that networks affect the way information diffusion. So we want to see whether by analyzing how the information diffuse in the market, if we can, kind of go backward and try to understand which one is the type of models of social interaction that can explain that kind of diffusion we observe. And then, of course, we have some side question around that, for example, around how does the ability of the markets to reveal information also depends on where the informed ones are. So the insider traders are located in the market, and whether the behavior of the insiders themselves may be affected by the structure of the network. And the way we answer this question is with a combination of control laboratory experiments and agent-based simulations. So why are we interested, first of all, in over-the-counter market? I suppose all of you get the difference, but as I wasn't sure about the audience, just briefly, if you, there are different types of market arrangements. So there is the so-called continuous double auction as a mechanism of price formation, which is a centralized market mechanism where all agents interact with each other through the limit order book. But there are many markets which are decentralized or over-the-counter, and this is the case of foreign exchange markets, interest rates, lots of financial derivatives contract, but also bonds and, of course, real estate. So in this kind of markets, investors trade assets directly between each other or from dealers. And the reason why there is a lot of interest in this market is because following the financial crisis, in particular, regulators expressed concern that the opaque nature of this over-the-counter market may exacerbate financial crisis, may make it more difficult for the true price to form and for the liquidity to reach satisfactory level. And there is, these markets are less regulated, the centralized market. So there has been a lot of reforms introduced, and there is a push to move away from the counter market into a centralized market. But of course, this push and this transition is not necessarily easy, particularly when you have assets which are not sufficiently liquid. Is costly to move to a centralized exchange, but also in general, there is very little understanding of how these decentralized markets compare and work. So we thought it's interesting to try and understand a bit more about how the price formation mechanism in these markets is determined. And for me, particularly because I'm interested in networks, this decentralized market, of course, can be represented as networks. So that was an additional somehow attractiveness. And I mean, it's quite obvious how this represents the networks. You can imagine the traders as the node and the link as the trading relationship between those nodes. So now there are two types of frictions that matter in decentralized markets. One is information frictions and one is trading. So information frictions here related to the fact that in this market, investor trade so negotiate privately the term of the trade. So other agents in the market that they may not know at which price a trade took place. So it may happen that at the same time, in different points in the market, the same transaction occurs at different prices. And that create, and the network structure may create heterogeneity in learning opportunities, as perhaps agents who are more central, they can observe more transaction and they have more opportunities to learn. At the same time, there are trading frictions because the market is incomplete. And then again, you could imagine that agents who are located on some particular nodes on these networks may have better opportunities to profit from having a more market power effect.
So, sorry, so in the previous slides you referred to price formation, which is the standard term. So there's no, if you think about price formation, there's no given value in advance. So agents get together, a price forms.
Yeah.
So then you'd speak about learning on the other hand, which implies that there is some objective information to learn.
I will explain how it works. Yeah, so the agents are given. So there is a price, there is a true price for the asset. Yeah, I'm just going to explain it, but yeah. So just to give a little bit of a broader motivation, and yeah, so then, other questions. So in this market, what we will be doing, we will be trading basically called contingent claim. So if you want, with a corporate bond, which either defaults or doesn't default, so pays at the end the dividend, which is either high or low. And some agents are given, and all the agents are given some information about the true value of the dividend, but the precision of this information is heterogeneous. So some agents know the signal with 100% certainty. So those are the insider traders. The others will have a noisy signal. So there are some insider traders, and then some of the side question we also try to understand is whether the network structures may affect how the insider trader behave. And typically the insider trader have to balance two, so there is a trade-off in their decision, and they may want to exploit their private information, and they may want to exploit it before others do it, so they may have an incentive to trade fast, but at the same time, they may want to hide the information they have, because otherwise, if other agents learn that information, they cannot profit from it. So they need to sort of solve some kind of optimization problem, and you would imagine that the structure of the network may affect that. So it's some kind of, the behavior of the insiders themselves is something that you would expect to be determined by the network. So how aggressively they trade may change depending on the network structure, and that may have an implication then in terms of how much others are able to learn from them.
So you set your information asymmetry independently on the initial network structure. So those are two independent things.
Yes. So I have different network structures, and then I allocate this.
But from the beginning, you have two types of agents, nodes. So one's more informed and less informed.
Mm-hmm. But they are random.
You create an.
I'll explain how it works. I don't know. I was planning to explain, it seems like maybe you want to know. I'll go back perhaps. I explain how it works because it seems like this may help you understand a little bit better what I'm trying to do. Okay? So we have an experimental design which consists of 3 different types of markets. So these are 14 nodes. And these are fixed, so the network structure is fixed, is one of these three structures. So we have a degree, average degree of 4. And and we look at the circle networks where there is no heterogeneity at all in the degree. All agents are connected to the 4 closest nodes on the circle. Then we look at the small world, and this is just one of this link we rewire. And then we keep rewiring a little bit more, and we generate a random network. And then so these are the network is fixed, so we are not using a randomized version. So for all the experiments, it's one of these 3. And then we have our agents that, as I said, can trade an asset, and the asset value can either be high or low. In this case, it's either 100 or 200 units of experimental currencies. And all the agents receive a signal about the value of this asset, and they know that this signal is correct with a certain probability E. And this probability can either be 60% for the majority of the traders, but then for a few traders, which is actually either 1 or 2 or none in the various setup, that probability is correct with 100% probability. So they get a signal which says the value of the asset is high with probability 60%. Or they get a signal on their screen saying the value of the asset is high with 100% probability. And they know that the 2 possible payoffs are equally likely, and they know this value. Okay? So the probabilities are known.
So if they're the informed trader, do they know that the other traders are not informed?
No, they don't know, because they know that in each market there can be either 0 or 1 or 2.
Okay.
So, but they don't know.
It can't be 13. So
No,
they know they're
can
inside.
Yeah, they know that
Right.
it can be 0, 1 or 2.
Right.
What do you mean 0, 1,
In the endogenous, this probability. For me, it should depend on the network structure.
Yeah,
Initial. You don't
this is not.
consider any.
No. This is all given exogenous, and it is not. Yeah, and so what do I mean 0, 1 or 2? I mean that there is either no insiders or 1 insider or 2 insiders. Yep.
Yes, experiment when you have companies. So I don't understand why you have a fixed network. In the bond market or something, I can trade with whoever I want in the world. So here you have a fixed network just because you imagine that in the world, people kind of limit themselves to their friends and okay, I understand.
You sort of yes. I mean that's a good point.
There's a table of evidence that it works that way too.
Okay.
Typically, the network should be endogenous, and I agree that they should be endogenous, but when you do experiments, normally you sort of assume that there is a given exogenous network structure. I mean, there are experiments where you can also allow the network to form endogenously, but in these experiments, the network is fixed. So, and tries to capture the fact that there are, this kind of trading potential that you cannot trade with anybody.
But there's no dealer.
There are no dealers here. So this is just an example of, okay, so first of all, let me tell you about, so as I said, we do treatments with 0, 1, and 2 insiders, and so we run 20 markets, so this trading activity can go on, we repeat it 20 times, and the markets last about 7 minutes in these experiments, and then for each of the various treatments, which will be the circle network with no insider, 1 or 2, the small world with no 1 and 2 and so on. So for all the treatment we run about 20. We always try to run 20, but you do the experiments, sometimes things go wrong, so you lose some of the data.
When you say number of markets in the table, what does that mean?
Sorry,
Like what is,
try to go.
if you say there's 20 markets, so it's a number.
20 market means that I repeat
You repeat the experiment 20 times.
yes.
With that
particular
With that,
network,
yeah.
sorry, with that particular networks, but randomizing the position of the signals. So while the network is fixed, who are the informed? They are informed change all the time.
and different students.
And different students, yeah, we randomize the group of students. The students are all kind of students who study the economics of business, so they have some sense of what the prices and what the market is.
So it's within subject. So I enter the room, maybe I'm an insider, and the next round I'm one of the insider. So you might have some learning effect.
Yes, so you are. Yeah, so you are the learning we hope happens within the same market, but of course, those people, everybody trades more than once, but not necessarily in the same role. And you may be trading on different networks. So we are really trying to make the learning, to look at how the learning within one market and not across.
So your students don't change from one market to another. That's because if you change the insider, but you keep the same group of
No, everybody change. They are kind of randomly allocated to the experiment. So it might be the same group, but perhaps that. So they are never really trading together anyway all the time. So there are various markets running simultaneously, and they
but
get
the sample
randomly
is the
allocated.
same. The sample is
No, there is also some students only participate in some experiments and some participate in others, and you sort of try to control.
And are they all just sitting at terminals, or
They're sitting in-
can they make eye contact and stuff?
Okay, they are sitting in a room,
Yeah.
and these rooms are got separation, and also you are sitting in front of, so you shouldn't be able to see anybody else,
Mhm.
but you are already sitting. So let me go back now to try and explain what we are trying to do. Okay, so first of all, there is a huge literature in economics about how markets aggregate information, which I'm not, it's in the paper if you'd like to see. I wanted to focus more on the kind of literature on information diffusion. And you probably are familiar with the fact that there are two big families of models for contagion or diffusion. One is the so-called simple contagion models. So this is the case of the spreading of diseases, for example, where people can become active with each independent exposure to an active agent. So in this case, what really matters more is the absolute number of active neighbors in determining your ability or probability to become active yourself. And typically, networks which have so nodes with high degree have a higher probability of being infected and also infect others. And as a result, what is found in the literature is that the node networks which have a higher variance in the connectivity distribution also have a lower diffusion threshold. So diseases propagates better on scale-free networks, say, than on regular networks. But there is another type of models of contagion or diffusion, which are called more social influence, where people become active only if enough other people in the reference group are active. So these are the so-called threshold models. And in this case, having a high degree doesn't necessarily make it you more likely to be infected. In fact, it's the opposite, because if you need, say, 50% of your neighbor to adopt, for you to adopt, so these are typically used for adoption of innovation. If you are 8 degree, then a degree of 8, then you need 4 of your neighbors who have already adopted. So in a way, the higher is your degree, the less likely, maybe, especially at the beginning, where there are only a few seats who are active. So the less likely is that you actually become active. So in these models, in this type of complex form of contagion, in fact, it has been observed that they tend to diffuse better on different types of networks. And in particular, there are some papers both in economics and computer science or physics that show that, for example, networks which have more heterogeneity in degree, which is what the second order stochastic dominance means. So networks which are more heterogeneous in degree with the same mean value of the degree, they diffuse better. Some of diffuse better whatever information or whatever process you're looking at when the sort of the rules are a little bit more complex. And also, there is some evidence that cluster networks can better promote this complex contagion. In fact, there is more recent literature here that that show that it's not really so straightforward. In some papers, they find that clustering can enhance diffusion. In other papers, they find that clustering actually slow diffusion down. And then there was a recent paper that I mentioned in my paper, but I didn't add it to the slides, so where they actually say that it depends on the intensity of the threshold. So and you can understand that, right? So basically increasing the threshold means moving farther away from one type of models to the other. So when the threshold is very low, it's very similar to
So here in your experiment, what is the decision they face? It's not a binary decision.
no. I'll come back to that later. So yeah, so I'll come back in a second, but just so the threshold really matters, because if you have a very low threshold, with just it's very quick, very easy to adopt or to learn, right? So then it's similar to a simple diffusion model, and then in that context you expect heterogeneous networks to diffuse better. But if the threshold is very high, then you need a lot of interaction, and that's where the clustering may help diffusion. So let me say one more thing, and then I'll come back to your question. So now this, so here basically is an interplay between degree of clustering. You know, what is really helping diffusion, and this relationship between degree and clustering and the spread of information is quite complex, because high degree. One can high degree be helpful, particularly in this context. For us, high degree would be helpful if the identification of the insider is easy, right? So if you can easily identify an insider, that insider is the only person who is going to influence your learning, right? So you see, you say, okay, that's an insider is buying, so the price is high, right? So you don't really need to interact with anybody else if you are sure that somebody is the insider. So if that is the situation, if the insider trade aggressively and they really make themselves recognizable, then you would expect that a high degree node will learn faster and an heterogeneous network will diffuse information quicker. But if the insiders are not very easy detectable, then you will learn more by observing the order flow that comes from all your neighbors, right? And you will need a lot of interaction with your neighbors until plausibly, that's what we are sort of arguing. You look at the imbalance in order and orders to buy and sell, and that that's what is sort of driving your learning, and you need that imbalance to build up to be able to learn. So why then in that case clustering helps? Because if you are in a clustered neighborhood, you kind of learn you support each other learning, because you are all connected to each other and you are kind of connected to the insider. So the insider trades with me, and I start to maybe getting oh, there's somebody who's buying, but then he's also trading with you, and you say, okay, also another buying. Then you trade with me, and you're kind of all learning simultaneously, right? So having a cluster community helps achieving a critical mass of nodes who have the same sort of expectation about the fundamental, and that facilitates learning locally within the cluster. But then there is still the problem that then while clustering may support learning locally, spreading the information from one cluster to the other is still very slow in this network. And you can imagine in your circle network, you have to really move little by little along the circle, while having a more random network, you can reach different corners in the network a lot faster. So in the end, what determines which network spreads information faster is really the difference, the gain in speed you can learn individually from learning by being in a clustered neighbor, and the speed at which the information diffuses throughout the network.
Like in the case where there's no insider, there's nothing to spread. It's a different.
They still have information, right? So there is still everybody gets. So the information is correct with 60% probability.
Yeah, but I mean this analogy with contagion, with epidemic type contagion, is you inoculate one node and then it spreads.
Yeah.
I understand with the insider, but case where there's no insider, they're just fumbling to form a price. There's nothing is spreading.
Yeah.
Basically.
Yeah.
So it's a different.
In a way. So,
Not quite, Rama. I mean, because if I understand correctly, each agent gets a signal that's 60% correct, but they're getting different signals, right? And so if you could know what everybody knew, you would have a much better estimation of the true signal,
Yeah, but I mean,
right?
it's
So,
not like
so if you
we
figure out
inoculate
that
the
guy must have
knowledge.
gotten a different signal than me, and you see lots of other people have different signals, then, so there is an aggregation of information, it's just murkier and slower.
Yeah, but it's not a contagion.
It's not,
Well,
it's not a contagion, it's still, you know, it's still, you can imagine they're
It's
still
communicating.
aggregating, but they're not communicating, but yeah. They
it's a diffusion of
understand that,
information.
so it's a diffusion, yeah, so I use contagion just because these are models of contagion, but I'm looking at diffusion, so I
A
like
consensus form.
consensus formation in this case. Okay, so coming back to your question, so that is what, so you're right, that in this model, in this threshold model, usually an agent adopt, and then they cannot go back, right? So either they adopt once they're adopted, or in models of epidemiology as well, once you're infected, and you have various versions, but typically then you are kind of, you remain infected, right? Well, here what we want, that when we do develop the agent-based model, we sort of get inspiration for this threshold model, but it's slightly different, our model, because first of all, we want agents to be able to, you know, learn, but also change their mind, and you know, we think, okay, you start thinking the dividend is high, and then they switch, and they go back to thinking the dividend is low. But also I want to incorporate prices here, so I want to, you know, allow them to learn slowly. It's not just a 0-1 process, but they slowly learn, and as they learn, they update the probability, and that determines the price. So I will explain that more clearly later. Okay, so anyway, so then here, our two hypotheses that we want to test is whether, you know, this learning is driven by simple contagion. Yes.
There was just a question.
From the Zoom. Okay. They lower the hands. Okay. All right. So, so there are two hypotheses. So the first one is that is learning happening through simple contagion? So that would mean that learning is driven by independent interaction with these insiders or better informed traders, and then is locally enhanced by degree. And in this case, then the random networks lead to markets which are more efficient and fair. And even more so when you have two insiders, you would think, because you have these two seats at different corners in the network, and you know they both help spreading the information. On the other, in the other case, if learning happens, you know, if the insiders are not revealing themselves, and then the learning really happens by aggregating the signal of all your neighbors, so it happens through this independent interaction, then you would expect that the nodes which have a higher clustering or maybe a higher centrality, I'll skip the slide, I'll go back to that, then can learn faster than the nodes which have the highest degree at individual level. And maybe at market level, you may find that the less more regular networks may compete, or you know, even perform better than heterogeneous
But
networks.
here
So,
they all have the same degree, so there's no high degree nodes.
yeah, no, they do have, no, in the circle they have the same degree, but
But
in the other, in the random network and in the,
Oh, I thought you just rewired.
There are three types.
yes, I rewire, so the number,
Okay, so
so I rewire, so the number of links is fixed, but not the degree. So why am I mentioning centrality here is because, sorry, I skipped that, because if you have a sort of more complex type of learning dynamics, you would expect that centrality may be more important than degree in terms of learning, because especially if you're not close to an insider, so you're not learning directly to the insider, but you are, you know, learnings from the neighbors of your neighbors and so on. And by being more central, you may have a better chance to aggregate this dispersed information which is in the market. And also, if you have a high degree, you may have a better opportunity to learn, but you also have a higher risk of being exploited by those who know more than you. Right? But if you are more central, because centrality and degree are not necessarily correlated, you may, you know, benefit from your centrality in terms of learning without being exposed to the risk of being exploited.
So it becomes somehow an insider.
I will actually show you, and in the end, what we find is quite interesting. I found, and you know, somehow unexpected at the very end. So this I've already explained. So this is an example. This is just to show you what they see on the screen. So they see only the local, to whom they are locally connected, they don't know the network. And they see the orders that they received from their neighbors. So you see here, so yeah, these are their 4 neighbors, and then they see, how much they are offering to buy or to sell, and then they can see the offers they themselves make to the neighbors, and if they want to accept an offer, they just click on it and they accept it, and they can also cancel the offer if they decide to cancel. Otherwise, the offer stays there until it's cancelled or accepted.
What are the restrictions on how much they can trade?
They can trade only 1 share at a time.
Okay,
Only 1 stock at a time. Yeah. And they have 10 stocks each, so they can trade and a lot of money. So this is something experimentalists do like that because apparently
so they have 10 different stocks.
not the same. I mean, yeah.
There's
shares.
There's
Sorry,
one S
no,
or there's
they
10
have
S?
10 shares. Of
10 shares. 10 shares of one stock.
No, but
Okay, but they can only trade 1
One
share
at
at
a
a time. But they can offer different, they're selling, they can offer, do they say I want to sell, or do they sell at some price?
They sell at the price and can be different for each. So this is
Okay, so they have to decide what price they're gonna quote.
yes, and they could quote different price to different neighbors. if
Okay.
they wish.
Okay, and similarly, do the buyers place, I'd like to buy at this price, or the buyer just says I want to buy?
Maybe if you show a screen with Phil.
Yeah.
Yeah, I don't have unfortunately, but if you, I don't understand. So if you see your offer that you don't see, you just click on the one you want.
Mhm.
Okay, so you don't have to take the best or whatever. You can
Okay.
just choose which one.
But if I want to buy,
Yeah, if you want to buy.
do I just say I want to buy 1 share, or do I say I want to buy 1 share at and a quote a price?
Yes, you go to, I come to you and they say, I want to buy a share at this price.
62.
Yeah, I can ask you, and then I can go to
But-
Susanna and I can ask to buy exactly the same share. at
But
a
here,
different
they
price.
know the 2 prices, they know it's 60.
Are the sellers are originating the prices but not the buyers?
No, everybody,
Buyers post prices too,
yes.
so it's a
They're not-
negotiation process.
In a way, they're a negotiation, but we don't model it as a negotiation.
Okay,
But you can go, so I can come to you and I can say, I want to buy at 60. And you don't accept and come back to me and say, I want to sell it to you at 70. So that's how the negotiation
Okay.
happens.
Buy at 60.
So it has to
Fine,
happen
good.
through
I get
written
it.
meeting order.
Okay.
Yeah.
Thanks.
So if they know it's 60 and everybody knows that everybody else has either 60 or 100, they know the numbers.
Mhm.
Yeah, so they know that the price can either be 100 or 200.
Oh,
Yes.
100 or 200. sorry.
Yeah, so those are the prices, and
And
they
so
know that.
they know that everybody else has the same numbers.
Yes, they know that everybody has the
Oh,
same
okay.
payout. The payoff are the same for every age.
So,
But they start trading it.
well, that's,
Let's say.
Well, at the end, they cash out with whatever the price is, right? I
So
find
at the end,
10
yeah.
shares and the true price was 100, I get $1,000.
So at the end, they pay off, sorry, I don't think I answered the question, but what they gain, I mean, they always gain a fixed fee just for participating, but they also gain, so you compute the value of the portfolio at the beginning, as they have at the beginning, assuming the correct price, and then you compute the value at the end with the correct price, and they gain the difference.
Mhm. Okay,
So if they do the wrong thing, they don't gain.
so there is a correct price.
There is, yes, so at the beginning, I select the dividend, the experimenter. So I know, okay, so for this round, the dividend is 200, right? Then I give signals, which are correct with 60% probability, right? So if I have 10 participants, it's a
some of the signals say 100.
So for some, the signal will say 100, for some, the signal will say 200. Okay, they get different signals. Yeah, but on average, there will be more correct signal than wrong signal. So on average, there is information in the market that if correctly aggregated, the price should converge to. Yeah. Okay. So what we see here, I'm not showing you the prices, if that's what you wanted to see, but I have the prices somewhere. So what do I see? So what we are looking at, okay, so we look at two things, and I'm showing you two things. So one is the individual order submission and the individual profit, and then the market level efficiency and the pricing quality. Okay, so I do some regression here, and I show you data, the results of the regression when I pull all the agents together, or I separate them in groups. So I separate those who are the insider, the neighbor of the insider, and again I split it in two groups, those with the correct signal and those with the wrong signal. And then we have the group of those who are not directly connected to the insider, and then they have either the correct or the wrong signal. And here, of course, in these cases here, there are only the cases where there is an insider. So what is interesting here, I just want to somehow, first of all, we show that, so what I show is the mispricing. So how far they quote from the true value of the dividend. Okay, and what I show is that those who are insiders and those who have the right signal, they quote closer. Right.
If it erase touch.
Yeah. Which one? This?
Touch the erase.
Is this the reference?
Try again. Oh, no.
That's okay. This will be the reference. Yeah. So, so those who are informed in a way, they are revealing a bit of the information, right, by trading closer to the true prices. So in principle, there is a possibility to learn. But then what's interesting is those agents who are higher clustering, they also trade closer to the fundamental, which we interpreted as them having learned better, because this is aggregated over the whole market. So those who are to have a higher clustering coefficient, so they seem to, at least from the way they trade, they seem to reveal that they have understood better. Yes.
I guess I don't understand what this table means. Are we
Okay.
looking at a regression table?
It's a regression table.
Regressing what against what?
I'm regressing the price, the distance between the price at which they quote. I look at the old prices in a market, and I look at how far they quote from the fundamental.
So what is insider?
So we don't, yeah, so then I control whether they are an insider, that they are.
Yeah, but how do you interpret this? Why insider minus 14?
So the insider is quoting closer, right? I get that the distance from the fundamental for the insider is less than the average agent.
What is the average? I don't see where that.
So the average here, the reference agent is a non-insider agent. I can't remember now. If it
What would their number be? How do we know whether minus 14 is good or bad?
Is the first is 49 is the average?
No.
That's the intercept.
So this would be 14 unit of currencies closer
Yeah,
to
it's over 200, but what's the average guy?
The
Quoting
average
at-
figure.
But the intercept in a way.
49.
Oh, okay, all right, right.
Okay, 49.
Um,
Okay, so 449 is the average guy,
Yeah.
and then the insider is 14 units closer than the average guy.
in a sense, I mean, it's not exactly, but yeah, it's not exactly, but
And
yeah.
the inside, so you have a dummy variable, insider or not insider.
yeah,
right?
right or not right, and then I have the degree, I have the betweenness, the clustering, and then I have the, you know, being both an insider and
And the
clustering,
cluster.
and all these other variables.
Inside,
So being a circle market, a small world, having two insiders instead of one, and having.
But that's very small effects, right?
Yeah. So if there are, okay, so the stars means that is significant or not, and to what level. So 3 star is very significant, and 0 star means it's not significant at all, right? Okay. And then, but I highlighted the one I wanted to discuss because these are the most important here for the point I want to make. That is these two really, right? So it's that the agents who are in a cluster neighborhood, they quote closer to the fundamental. So which means they know better. But if you have a higher degree, you know, that doesn't make any difference. So having a high degree doesn't help the learning process, but the clustering seems to do. And this is not driven by the fact that maybe the insider in a cluster neighbor behaves any differently, because you could say, oh yeah, you learn better because the insider is be more aggressive. So that's not the case. So when the insider has a high clustering, it doesn't really make a difference to the way they quote, but people in the cluster neighborhoods, they learn better. And in fact, what you find, and if you divide by group, you see that the group that profit the most from the high clustering are those who are not connected to the insider and they have a wrong signal. So they are the most disadvantaged, if you want, in terms of learning. And you see that, for this group, what really helps them is clustering and betweenness, but not the degree. So degree doesn't really help, but having a high degree, high clustering or high betweenness makes them, better in terms of, this is not really, I cannot observe what they know. So I'm trying to infer what they learn from how they quote, right? So if you believe that this is a proxy from how much they learn, that's what the story here. Right?
And right, was it?
Right, so they have the right signal or the wrong signal.
So,
Okay.
I'm sorry, I'm probably being dumb, but I'm a little confused about the meaning of the coefficient. So a bigger value is better or vice versa?
No, so negative, right? It's negative. So this
Negative is
measure,
better.
yeah, negative means you have less mispricing.
Less mispricing. Okay, sorry.
Yeah, less
Well, that's
mispricing.
because we absolutely priced 49 too high.
Yeah,
So if you're minus 22, then you're
You're
20%.
all right, okay, right.
But there are two types of variables, right? On your right, so binary variables, dummies, and degrees between the so you mix them.
All right. Now, the other thing is the profit. Okay. So now the same table, so the same variables. So here now you see that the insider and those who have a right signal, they make more money. So first of all, they can exploit the information they have and profit from it. And then again, you see that, however, what you see is that when the insider is in a cluster neighborhood, they make a lot less money. So they can exploit a lot less their neighbors, which again, to me, is an indication that their neighbors have managed to learn the price and don't get exploited as much as they would otherwise do. And also, interestingly, again, if you look at the most disadvantaged group, what you see is that the degree is making less lose more money, they get more exploited, but having a high clustering, they actually get a higher profit. So maybe lower losses, this is just somehow, okay. So that is, then there are lots of other things, like for example, the more right signal there are, and the less the average agent lose money, and we should expect because there is more information in the market, so that information gets somehow aggregated. But we really spend too much time looking at every single variable.
And these regressions were over all of your experiments.
Yes,
We're looking at.
altogether. Yeah, but then controlling, you see, that's why I have under the neck. Sorry. Here I control for the type of disease.
So it seems that the network structure has nearly no effect.
How is it managed? Sorry.
No.
No, it does. So when you look here at the individual order submission, you find that in the small world overall here, there's simply more mispricing. And when you have the circle also, there is more mispricing. So the random network here overall seems to work.
It's a tiny effect.
Yeah, there are small effects. Yeah, in that sense. In an economic sense, they are not maybe economically significant, but statistically there is a little bit of difference. Yeah. Okay, so then if we look at the aggregate level, so now we look at the efficiency. I should have defined the mispricing at the individual agent as well, but basically we look at the distance between the price at which each agent in each market quote at each time. Minus the true value of the fundamental for that market, and then we average it. We take the absolute value of that difference, and then we do run again some regressions. Now here, what do we look at? Something slightly different. So we have again, so that these are markets now, not agents. So we look at the overall inefficiency in the market. So we have all markets, and then we separate the cases where there is no insider, one insider, and two insiders. Okay, so what do we find? If you put all of them together, yeah, it actually looks like the circle markets are more efficient than the others. But then when you start looking at them separately, you realize that it is actually when there is no insiders. So in those cases where there is no insiders, so where the information is certainly kind of aggregated, the information is spread by aggregating all neighbors' signals, then the circle markets is more efficient. But in when you have insiders, actually the circle seems to be performing not as well.
The efficiency, so
It's a price deviation.
Could you show the definition of efficiency again?
So it's
So it's a number between one and one. It's because we're taking
No, it's price units.
it's in price
So
units.
Yeah.
like the price is 100 and.
so the average price is 150. So if you are doing 50 means you are in the middle.
Yeah,
So
so
you
it's
are
very
not
far.
really learning. Yeah, it's very far. There is very
50
little.
deviation from 100.
Yes,
So-
yeah. So they are kind of,
Perfectly efficient and zero is perfectly inefficient.
yeah. So you are really,
So negative, what does
No,
negative
no,
mean?
0 is you're on target.
Zero, you're
So
on
this is
target.
you're 50 away from the true price, which
From
is
the true
100, so it's pretty
Mhm.
bad.
so you are basically at 150.
Yeah.
The average price is somewhere 150. So you are always, so there isn't much learning at all. Okay, so there isn't a huge amount of learning happening, which is also against all the economic theoretical models with actually
So if they learn nothing, it would be 60 because of your 60%.
maybe, yeah.
If they do strictly nothing,
Yeah, if they do strictly, if they just trade on their signal,
Yeah.
yeah. If they
so
trade
it
on
means
their
they
signal,
learn
yeah.
a little
They
bit.
learn
They
a
move from
little bit.
60 to 56, but it's
But
not
yeah.
worth the fuss.
Mhm.
They could just stay home.
Yeah, I mean,
But in fact, actually, okay, let me say something. So what would an economist tell you? They will tell you that in this market, there should be no trading. Because according to their models, they should all perfectly immediately learn, and then nobody wants to trade with each other because they already know that somebody is an insider. So if you are not an insider, you just wait and see, right? You don't do anything.
Yeah, I
And
mean,
as soon as somebody
When you have 0
trades-
insiders, it's 59.99, so it is very close to the theoretical 60.
Yes, so what
Nobody
we,
learns anything.
yeah, so in fact, why do they trade? I think that the reason why they trade is precisely because at least at the beginning, and maybe towards the end, there may be some learning, but at the beginning, they just trade based on their signal. They're not even trying to necessarily learn. So they are sort of, acting on their signal and then slowly, as because otherwise they wouldn't trade at all. But then they start learning a
the
little.
only information they get are the transactions they perform, right? In other words,
No, they-
if I didn't do any trading, I wouldn't learn anything because I wouldn't see anybody
No.
else's price.
No. Even if you do, you see the orders coming to you.
You do see the orders.
But then I wouldn't be able to capture it unless you trade, right?
Right,
If you do
okay.
nothing for
Right.
me.
Yeah,
there's
but
no way to
it's
capture your
it's
learning.
because you have only 2 prices. If I see somebody posting at more than 100, I say, okay, well, they must know something about.
Yeah,
higher.
but you don't know, but yeah, I mean.
Or they're like dumb.
That's what the economic theory tells
Yes.
you, right? So economic theory will tell you, if you get the 60% signal, you are better off doing nothing. And then, if somebody put an order, you should expect that person to be inside and then the game is over, but that's not what happens. But that's not what happens, they are trading, right? So it seems like,
Because this network is fixed, there's only a probability that you're trading as an insider.
Yeah.
So, I mean, it's a risk.
it's a risk, exactly,
It's
so they don't,
rational to take the risk.
no, but even there, in
There's only a risk
principle.
when you trade.
Yeah, but I think that's precisely what's happening, right? That, yes, they know that there may be an insider, but they're not sure that there is. So, they sort of, if they do nothing, they have nothing. So they, maybe just because they're bored, they could be that they are trading,
No,
but somehow they are trading,
But
right?
it's realistic because it's not their money.
It's also, okay,
So
fine,
it's
that's
very
me.
for financial-
It is a bit money,
They're
no,
not
they
gonna
do
make
have-
lose money at the
Yeah,
end,
they do.
right?
There
The
is
students
no
are getting
budget
paid.
constraint.
but it's little.
How much do you pay? Like
We
what would
pay
be an
about
average winning?
10 euros.
No, but you pay them independently of their
No,
gain.
no, but then they get extra money if they win.
Oh, I see.
No, there is.
And you know, no matter
a-
what. But they get a bonus if they win,
Yeah, they
and
may
how big
have
is their bonus compared to their base pay?
kind of,
Match.
if they win a lot of money, it could be much higher, but you know, yeah, typically. To double your earning.
Mhm.
Oh, you-
And
Yeah.
there's no budget constraint, right? That they can trade their, do they give a budget? So you have.
No, well, yes, there is a budget constraint, but we give them lots of money and only that share.
It's realistic.
Yeah.
It's like a trader.
I have a very basic question. So they have the insider knows exactly the truth.
Mhm.
Those who have bias signal, I assume the bias is mean zero,
What do you mean by it?
where they have wrong information,
Yeah,
right? So it's
yeah.
bias
Yeah,
compared to the truth. That bias is mean zero.
No,
No, 60% are correct.
True.
Okay, so then that is why you have that the average mispricing is always positive or always negative.
The average mispricing is not negative, I'm not sure where
So
you're
then it's
taking,
always positive.
yes.
because it's an absolute value. Right? I'm taking it.
Yeah,
Just measure it as
60%.
a-
but so if you were not taking the absolute value, it would be always positive because the bias is always positive input data.
Yes, you would expect that they get closer to the true price than to the wrong price on average. In that sense.
No, the bias is not always top positive. You can have the true price to be 100 or 200.
Yes,
So
Or
then
50.
Low and.
No, it's 200 or 100.
It's some probability.
So at the end, if you have 5 shares, just to be sure, at the end you have 5 shares, the true price is 200, you get 1,000 euros back.
Yeah.
Right. So,
Okay, I wanted to do that. It's a bit of a strange setting because then you are mixing up the variance around the signal and the fact that they have some uncertainty and the fact that there's a positive bias. It's a non-zero bias around the true signal. You could have had zero bias around the signal, right?
yeah, but
You could
I mean,
have said-
first of all, I don't invent this setting, right? So it's a setting which is quite standard to give, and I think it's done that way to encourage agents to trade. Because probably if you tell them you have the same chance to be right or wrong, it is less likely that they trade. But if you give them a signal and they think, okay, it's more likely that this signal is correct than wrong, it triggers them to act. So this is really something that
in principle, if they traded forever, they should figure out that what with 60% with 14 agents,
Yeah.
we do the math, but there's a high probability that the group, if they knew all the information, would know the final answer. That actually seems like an important
Yeah.
reference number.
Yeah, so you
That
want
would be
to,
perfect learning.
Yeah.
Where they were Bayesians and they somehow milked out what everybody had, even with no informed agent. With no informed trader,
yes, and
it's probably
yeah.
pretty close to 100% right.
no, but
If
what
they-
it's saying is that you cannot separate bias and variance in this experiment. That's true.
Yeah,
It's just
no, I agree.
the average-
Single parameter government.
The average belief is different from the true price. From the gate.
Yeah.
That if it's experimental setup that's validated, it's encouraged, that it's good to know, but.
Yeah.
This is.
yeah. so
And it's
yeah.
interesting that with zero insider, you get exactly the average belief.
Mhm.
Yeah, you would think they would.
59.99.
But then not everybody, right? So that's okay, but then if you start looking, okay, so this is now the market level, but then when you look at the individual agents, you find that there is heterogeneity there.
Mhm.
So, okay, so what I really want to show here, just to try and be quick, because we don't have much time, is that that basically the circle networks underperform the random networks, but if you look at the small world, the small world in this regression underperform when there is one insider, but when there are two insiders, then the two markets start behaving more or less. See, there is no difference between the two. And So this I just want to show that there is a little bit of convergence. Right? So this is the difference between, for the transaction in the second half of the market, the mispricing is a bit less. So this shows that there is a bit of learning, but yes, I mean, it's more. So we're talking about more. Okay, so, and then if you look at inequality, again, you find that the circle is doing a little bit worse, but the cross here means it's statistically significant at 15%, so it's not really very significant. And then if you compare with the small world, it's not significant at all. So I want to come to the simulation and the agent-based model that we propose to try and explain this. So the idea we have in mind, I mean, which is very obvious, is that you have an agent who makes an expectation about the fundamental value, which can either be 100 or 200, and then they update the probability that the true signal is 100. And these values are initialized to the initial value. If you are an insider, of course, you update. If you are an insider, then you update that probabilities. And once you have formed the probability, I'll show you how to update it. But once you have formed an expectation, then we assume they are randomly picked. And then they submit either a buy or a sell order according to some kind of normal distribution. And this. And then the counterparty accept or reject the offer, depending on whether the price is higher or lower than their expectation of the group. And then, the price follows some kind of normal. There are various parameters, and all these parameters we take it from the experiment. Okay, so the probability that they are selected, we match it with the experiments, the range over which they submit the prices. So we try to fit all that on the experiment. And the only quantity that we calibrate is the learning function. So that is the function. We have tried two different functions. In the end, we stick with this. So this delta here is the imbalance they observe. Okay, so they start with a 60% probability. So they believe that the price is high with 60% probability. Then they see more orders to buy than to sell. So they start increasing those probabilities until at some point, they kind of learn and that function becomes flat. So it's not the threshold model exactly, but, it is sort of not too far off from it. But this allows you to both go back and forth, increase and decrease the probability as you start seeing different imbalance, and you don't immediately go from 0 to 1, but to go slowly. So what we calibrate is the slope here. So how slow is that process? Okay, and then, so we have an objective function. The way we calibrate is by, first of all, we match exactly the volume. So we fix that to be exactly the same as in the various experiments. And then we look at the average mispricing across all the markets. Then we pick the delta that minimize that function. And, this is not the most beautiful minima, but, we find the minima at 4, which is kind of interesting because it matches exactly the degree.
Sorry, I don't understand that lower plot. What are you showing?
So this is the loss function as a function of this parameter that we're trying to calibrate. So we choose this delta. Delta is this point here. So is this point here. So it's the point at which we have the kick.
I see.
Okay, so which
is the degree? What is it?
So this is your
is what
you're saying after you make what is 4?
So what it means is that if you have an imbalance of 4, so you have 4 orders to buy more than the orders to sell, then you are 100% sure that the dividend is high, or that the dividend vice versa, the dividend is low. So how much you need to see in imbalance to achieve an 100%?
Where does this curve come from?
Which curve?
This curve is.
This is my input. So I assume that this is the function, and then I calibrate it. And we try different functions, we try different shapes, but it's not really changing anything. But I mean, of course, you start thinking something like weird.
So you calibrate the threshold?
Yes, so we have one parameter only, and I calibrate basically the threshold. Yeah.
Okay.
Yeah.
Okay, so 4 means then that if I've seen 4 more buy orders than sell orders, I conclude that.
Yeah. So you look at all the orders since the beginning of the market,
Yeah.
and you have
Mhm.
you build up this total number of buyers. So when that difference is 4, but then you
So it's a
change it,
difference
yeah.
between
But the
how many
prices-
buy orders and how many sell orders you've
I've
seen?
seen up to now.
Up
Okay.
to now,
Up
not
to now.
currently. in my-
No, up to now, from the beginning
Cumulative.
of the market,
Yeah.
this is up to now, yeah. Then you say, okay, but then it can change, next round maybe it goes down to 3, so you reduce that.
But whatever the price.
And then the price, you use that value there. No, the price you don't look at.
So you just. looked
So
at-
you learn only from the imbalance.
Okay.
So, but this is something that actually has been,
But it's important, right?
yeah, but in the literature, actually, they say that the imbalance is more.
Yeah, because in this
More
model,
than
the
the
price is, the price is either 100 or 200.
Yeah, but in
No,
general,
There are times to adjust your probability, so your billing.
Yeah, but
But-
because the price is binary, you don't care about the price. You just
No,
want
but
to see if the buyer or seller.
But Rami,
You
you're,
want to know whether
people are
you're close
quoting
to.
prices to you that are not, that are between 100 and 200. So you're seeing not just how many people are buying, what price are they quoting the
Yeah,
orders at?
because, but you know that the true value is either 100.
Well, at the end of the
doesn't matter.
day, but you might think that there's volume that they're quoting really high prices, they're really confident it's high as opposed to less high prices.
yeah, you could imagine a model like that. I mean, that would
Yeah,
be more
but since there are only
complicated.
2 possible values, you don't really care, right?
Yes, you
Why not?
do.
Yeah, okay, anyway, I'm curious to see the results.
Okay, so calibration. So now when we calibrate, and I'll show the results before.
I still didn't understand the calibration slide. What does this wiggly curve you showed us mean?
Okay, so this is this function,
Yeah,
which is so I compute the average price in my simulated market and in the real market, in the experimental markets, and I compute the difference across all the various 180 markets I have. And then I see how, and I choose a value of this parameter, and then I see how much is the difference, and then I redo it, choosing the difference until I find the minima. The minima is here.
okay,
Okay, so then I put the kink at 4.
it's, yeah. I guess would make you a little nervous that the function says. But
Makes me a
the,
little bit.
yeah. And that the value, the minima are pretty far apart too, right? If you took the second minimum
Yeah,
instead of the
yeah,
first,
Yeah.
you'd have a very different value of delta.
Yeah.
Okay, go ahead.
Okay, so then that's what we get. So here I'm showing this slightly differently. So so this is the mispricing. Sorry, I'm just okay. So this is a comparison of the experiment and the simulation. Okay, so this is the mispricing. So here you have the various cases without insider, 1 insider, and 2 insiders. So here you have the mispricing. So you see that the case of the random network with a strong insider, which means the insider in the most central node, is the market which had this mispricing. And here also, we recover it. And with 2 insiders here in the experiment, you couldn't significantly capture that. So the difference wasn't significant, but you can see that the more regular networks seem to be at least equally, so if not better. And that's in the experiments because we can run more simulations. So this is actually significant. So we have that we have 2 insiders. The small world network has less mispricing than the random network. So it captures that thing. There are other stuff, but we don't really have much time. And similarly, if we look at the inequality, it's the same story. So with 1 insider, the random network is better, but with 2 insider, we actually find that the more regular networks become better. But the thing I wanted to show you also is this one. So this is the last slide, really. So then now I know who they are. So I know what they think, because in the simulation, I can measure their misbelief. Right? So I know what is their expected value, and I can measure the misbelief. So this is their misbelief. And I show them the average misbelief based on, again, those 4 categories, being connected or not to the insider, and to be right or wrong in terms of the signal they receive. So what you find is that here, these are the right, and this is R1 means connected, R larger than 1 means that is not connected. So here you see that in the networks which are regular, so the circular network and the small world network, you see that the agents which are connected to the insider have less misbelief than the ones which are farther away. And that is true both for the right and for the wrong, right? So the wrong are, in fact, the wrong at distance 1 and no more than the right at distance higher than 1. And the same with the circular, the small world. But when you come to the random network, it's the opposite. Now, the ones which are farther away seem to have less misbelief than the ones which are connected. Okay? And then the way we interpret this is that if you are in a random network, even if you are connected to the insider, you are connected to a lot of other people who are not informed. And then, it's if you cannot really distinguish who the insider is, that doesn't necessarily make you learn the price better. But if you are somehow farther away, you are connected to you are more likely to be connected to the neighbors of the insiders, who have all learned a little bit, maybe not much, but a little bit. But now you are connected to lots of people who are learned a little bit, and that somehow helps you more in learning the signal than being directly connected to the insider. Now, this we thought was quite interesting, and I don't want to really spend my time summarizing the results. I just want to tell you that, this obviously is very much dependent on the specific configuration we have picked. And this is actually well known. And you know exactly where you put the information, exactly how you create the network matters for the diffusion. So what we tried and do was to, now we have an agent-based model, we can run as many configurations as we like. So we try to randomize the network and to randomize the signals. And if you look at the average, on average, you always find what you'd expect. So you find that the random network always perform better than the small world. But the problem is also that we couldn't calibrate those markets, right? Because the calibration is specific to the network we have created. So we are not really sure about how meaningful are running the simulations with the calibration, which is not really specific for other configuration. But said that, even if on average is not necessarily, it's still true that the random network diffuse better, it's not really surprising, but it's interesting that there are still configurations that will make the regular network diffuse better. And this has implications for policy somehow, because when you're thinking in terms of how you want to intervene to, for example, prevent insider trading, it is important to understand what is the overall the type of network topology you are dealing with. Because, for example, in a cluster network, is not just the insiders, but also the neighbor of the insiders that can learn very well, and then they can extract the profits from their neighbors, while in a random network is the opposite, right? Those who are close to the insider are the ones that may be worse off, because they can be then exploited by the insider and by those who are farther apart that seem to capture information better. And also, we find that in cluster markets, having so the markets become more efficient and fair if you have more insiders rather than less, as long as the insiders are close enough so they really compete. But if you are in a random network, adding insiders in terms of fairness, makes the market worse off, because those two insiders, even if you make them connected, they are not trading with the same agents, so they are not really competing as such, so they still can act pretty much as almost monopolists of information. So having more insiders that doesn't help very much in terms of efficiency, because one is enough to spread information, but makes the market much worse in terms of inequality. And then the position also change in a random network. Putting the insiders in a strong position or make a difference. In a more regular, of course, they are not really that different, the centrality, so it doesn't matter very much. So yes, sorry, we went a bit over time. Yeah, that was. Yeah.
Okay.
Thanks for the talk. It was very interesting. I wonder, is there any data on how these networks actually look like? Because I would expect that, from I mean, I know very little on OTC markets, and most of what I know I learned in last hour. But at the beginning, you said, it's like people trading with their friends, or people they also would expect more something like a scale-free type of networks, where probably also the position of the insider is not random, but is placed in some.
I can send you a reference of some papers which have been looking at on these OTC markets for derivatives. And typically they are called periphery type of structure. So they have a cluster of nodes which are the biggest dealers who tend to trade with everyone else. And then you have some peripheral nodes that they're only trading with some of them. So that's a typical structure that is so it's not really scale free, but
So they're not like this.
No,
they're not like this, but I have 14 nodes, so it wasn't really easy to have a scale free network, for example, or even a core periphery network.
But for example, if you did a study on the swap market, 2010, and there actually by construction, the dealers restricted the clients to not have more than 3 dealers. I mean, on Bloomberg, they were restricted to 3 dealers.
Yeah, no.
So it was a bit like the 3 neighbor. But of course, so
But then
it's
there
still
is
core
the-
periphery.
yeah.
So there is a core, and each client could connect to 3 in the core. So that's a specific example where
Yeah,
you know example.
We do kind of, we don't have a core periphery, but we do have so in the random, in this particular random network, you may think, first of all, if I did measure the core periphery, the algorithm measuring core periphery are very, maybe I even have a bit of core periphery, it's just that it wasn't intentional. But you find, so if you start, you will find some nodes which are a bit, closer to each other. And it's kind of captured a little bit by the centrality as well. So I don't think I have a table here with the centrality though. Yeah, but if you look in the paper, I give the centrality of the clustering of the, so the clustering in a way is perhaps a measure of being core, in such a small network, clustering and core is a good proxy. So yeah, some will have a higher clustering coefficient than others. That's the way you may think it's a kind of a proxy of that.
Yes.
But sorry.
I had the same question about the true topology, and it's true that core periphery matters, but also the fact that you set your probability of those insiders and non-insiders, informed and uninformed agents nodes independently from on the network structure. So it's sort of, so if you have a central, so if you think of a core periphery or a star form network like a CCP, for example, so which is the case for financial markets usually, then the insider is also the fact that he's an insider is decided by the network structure of the market. And so, and even in your case, you are saying that through the learning, they somehow, due to this cluster phenomena, they become somehow insiders because they adjust their knowledge of probability of being right or wrong. So if you, for example, if you introduce a sort of endogeneity of the probabilities, so probability depending on the network.
Yeah, I cannot do, if I do that, I lose completely the control. But what I want to say is that it's true that the network is exogenous, but they don't have to use all the links. So there is still an amount of endogeneity, the fact that they can choose whether they want to trade with all their neighbors or maybe just with one of the neighbor, or maybe they don't trade at all. So, in a sense, if you're an insider, you probably try to exploit all your neighbors, right? So in a way, those links which are available to you, you probably try to use them all. So there is an element of heterogeneity, but I agree with you that ideally you would like to let the network to be determined by the agents, and then of course having information may have may affect the way the network formed, but because here I want to control, how the information uses. So my question is slightly different, right? So I don't want to try and explain how networks formed, but I want to say, okay, given a certain network structure, how does the information spread? So, that context for me was important to be able to control the shape. But to be fair, there is a little element of heterogeneity as well in here, because I don't force them to trade. The agent-based model, in fact, to some extent, I do force them, because I say, okay, I pick you and you trade with this person, but in the market, they don't have to trade.
So you didn't show any plots of what's happening through time.
Yeah.
And when you set this up with the insider, the first paper I thought of is Pete Kyle's paper, where he shows the optimal strategy for the insider should be to reveal the information incrementally and have, therefore the price should be moving linearly towards the final price. Did they do anything like that? Like when there's one insider in that special case, Pete Kyle in principle gets a little different because he just has the insider, noise traders, and a market maker, right, in his model. So he doesn't have these 60-40. You got that instead of the noise trader.
Yeah.
But do you see anything like what Pete Kyle predicts should happen?
So in this particular setup with the pairwise interaction, the price is quite messy, and you don't really see it easily by your eyes. It's difficult to see the convergence. Before I did another experiment, which is slightly different. So there we have a network market, so not a pairwise interaction. So there's a lot more trading. There you can really follow the price, and then there you can see that sometimes it does converge to the correct value. Sometimes actually it converges to the wrong value. Sometimes they stay somewhere in the middle. So there you can actually monitor the price a bit better, because there is a lot more activity that you can, that is less volatile. In these markets, the average price is still quite.
Yeah, I'd be curious how Pete
But I
Kyle
can-
will respond.
But I can plot it.
Telling us that his theory is wrong.
No. Well, basically here it's what we were saying before. There's very little learning.
Yeah.
On average, and so the average price kind of really stays. It's a bit noisy, and on average you stay quite close to the famous 60-40 away from the fundamental.
As far as I remember, this model, I was model, the specific problem is checking the market. So I don't know exactly how it features when there is no market maker.
Pete Kyle would claim this applies even without a market maker. He says market impact should be linear because that's the logic behind it is that information revelation, which is that if you're the informed trader, then you don't want to give your information. If you just immediately bought everything, then you get it at a high price because people would see what you're doing. Whereas if you do it little by little, you're dribbling out your information. And of course, you've set it up. So in principle, people would spot the noise trader and go, okay, immediately jump to the conclusion, because whereas in Kyle's model, it's you don't know, your setup's a little bit different.
Because there's no
But
market.
it shouldn't really depend on the market.
But there's no market impact.
What?
There's no market impact.
Well, there's always market impact if you have information. So the noise trader, there should be market impact, right? Because the noise trader, he knows, she, whatever it is, knows, what's going on. And so the others, if it were, they should be able to see the informed trader and then go, aha, and then they should be unwilling to take bad offers from the noise trader. And so I think there is market impact for sure. There's always market
I don't
impact.
see why it would be linear if it, because if I know that the true price is either 100 or 200, I just want to see which one it is. Whereas in Kyle,
Yeah,
they say, oh, maybe it's 101.
yeah,
maybe it's 102.
it's Gaussian distributed. So it's- Yeah. Yeah, so yeah, maybe that makes it different.
I can really jump to 199.
Yeah, except you aren't gonna know with certainty what the price is, so your expected price. Right, you know, it's either 100 or 200. But if you think it's, then the question is, what is the probabilities you assign to those two numbers? And how is that probability changing through time? Which is gonna affect the bids and offers you make through time. So I think the basic
There
idea
will
should
be a
still
bit of
apply.
pricing.
Should maybe rework it. You could just rework the model for this setup. I don't think it would be, you know, your setup's
But we
almost
don't see
easier.
anything about price behavior.
We don't really, what do we?
Well,
what
that's
do
what I
we-
was asking her. If you plots prices through time,
Yeah,
Pete Call would say the average price of the transaction should go up linearly
Yeah, we
from
don't
the
know.
start to the finish.
We don't know what it would be.
you know,
She measured it though. She saw them.
yeah, so I mean, I could fit, you know, with, if, from what I remember, I can fit anything with those points, I
Yeah.
can fit a linear, you
No,
can
but
fit
there's
a
no
non-linear.
fair notion of price.
It's very,
Yeah, price is bilateral trades taking place.
yeah,
Like,
exactly,
in a
but it's
different
not
political
any,
way.
yeah, it's not big prices, so it is.
There's a mean
There
price
is
for
a
the
mean
whole
price,
market.
yeah, there is a mean price, I mean, I can plot the mean, all I'm saying is that the price was kind of noisy.
One thing that's really good is if you can show that your model is fitting the data,
Mhm.
then you can change the parameters of your model.
Yeah.
So I'm very curious what would happen if you change precisely n, because
But it's-
the number of agents.
Okay.
Because of course, you know, it could be that people don't learn just because things are super volatile. And things are super volatile because you start having a diversity for each agent to aggregate information, and this should presumably run the GNS model with more.
And general, yeah.